Hello guys, and glad to have you on board again today. Today is going to be a very important video for you to look at, probably needing to look at this one multiple times eventually, or if you don't, you're probably going to have to look at this one later on in the progression, just like a reminder of the core rules of these third range boundaries. So today, really a keystone and important corner for your progression into trading. Even though you might think that the third range boundary isn't that big of a deal, and let me be honest, it actually isn't in terms of actual rules and stuff you're going to have to memorize today, but it's going to be a lot more complicated when it comes to really applying this into real-time market behaviors and market conditions, in which a lot of emotional biases will step in. And later on into this series of video, we're going to talk about this, all of the impatience biases and fear of uncertainty, which is going to be at heavy load into these ranging contexts. But anyway, even though some external effects will be implying into your trading, you're necessarily going to have to deal with them sooner or later. So I'd rather like you to deal with this in the first place, so we build some safe grounds in which we can start building walls, and later on building your roof and a house in which you probably, at least I hope so, sustainably going to make money into the markets. So yeah, it might sound counterintuitive to start with the range in order to get to learn trend following, but you need to understand that actually trends comes from short-term ranges maturing and not reversing. So a trend exists because hesitation failed to reverse. It might sound stupid to say it that way, but that's truly what this is all about. And I hope sooner or later you're really going to get to understand that thing when I'll be teaching you range trade, and we'll switch to trend trade. You'll see that what we're talking about today was actually a much bigger deal than what it sounded like when you first listened to this podcast. So that's the reason why, actually, if you're looking at this one in the first place, you might say, fuck, cut the crap, let's go right to the pattern. But if you're looking at this one in a second perspective, later on into your trading progression, you might be saying, oh, god damn it, he was a smart motherfucker. So yeah, that's exactly what this thing is about. A little bit talky introduction as usual, but we'll get right to the interesting stuff later on, don't worry about it. It's just absolutely important that you understand that this thing has a much bigger perspective than what it might sound like in the first and at first sight, okay? Anyway, cutting the crap, let's go right into some more technical stuff. We're going to use PowerPoint today as a support, so it gets easier for you to understand the processes in here. And of course, we'll make a lot of videos, either the daily updates and stuff like that, in which we're going to review and apply into real-time market conditions, all of this stuff I'm going to be sharing today. All right, let's get into it. Okay, so for those who read the PDF manual, you might be familiar with what is in front of you right now. This is basically one of the latest pages of the PDF manual. So of course, I'm not going to jump into whatever the context boxes are, whatever, just going to use them. So I imply that at that point, if you're looking at this video and using the indicators, you have read this motherfucking PDF manual entirely and eventually multiple times, that whatever I'm going to be talking about, you know what this is all about. If you're not using the indicators and have looked at the previous video, then you understand that you need to just switch some of the vocabulary I'm using, and specifically the context and trend channel things, by your personal trend channels and pitchforks, okay? So basically, a trend is trading into a trend channel or breaking through one in the side of a trend, okay? So if you have an upside trend channel and you're breaking it to the upside, that means an upside fucking trend, okay? At least a breakout trade, okay? If you break a bullish trend channel to the downside, that means neutralizing the trend, therefore put your pitchforks at place. If the pitchfork level gets severely broken and breaks to new high, then back into trend, a new channel and whatever, okay? You oscillate one to another. I hope you do understand how that thing works. Otherwise, you need to practice a little bit more before getting into the real stuff, okay? You need to totally master the tools you use, absolutely necessary. That's why we talk a lot into those podcasts, but this is also why there is a progression. If you don't validate the previous step, don't move to the next one. Okay, though at that point, I consider you know what the indicators are all about. And if you're not using the indicators, you know how to replicate them with your own tools. Okay, so anyway, what matters in here, whether you use the indicators or not, is the global thinking way and processing way of the strategy, the progression. Okay, there's going to be a logical projection to this thing. And the thing starts with those green level type of trades, number of 2, which is the 2 third range boundaries. So yes, congratulations guys, today you're not just going to learn one pattern, you're going to learn 2, but this is basically a 2-in-1 type of thing because they actually have the same structure. It's just slightly different stuff and slightly different risk management that we're going to be talking about here today. So the first trades you're going to need to master are these 2, and I also managed to make the colors fit the Discord progression, which means if you have a green color in Discord, that means I think you are mastering this third range boundary. If you get a yellow color, that means I think you are mature enough to safely trend trade, which means other people that are getting to learn trend trading can refer to you as a safe person for corrections or advices or review, whatever, but at least I feel like you have learned most of it. That doesn't mean you totally master it. No one totally masters everything, but basically you know enough to help other people out with this context, okay? So green guys can help you with the third range boundary. That means they got the perspective of the pattern, they totally are able to figure them out, and they should be able to help you if you are getting into it, okay? So green level also means this is the easiest patterns, and we of course start with the easiest pattern. But like we said, bro, the picture, we're actually going to use the third range boundary into multiple contexts, and specifically, if you don't master third range boundary, you just can't get into trend following, because we're going to need to study the third range boundary reaction in order to trend trade, okay? No spoiler in here, but we're going to talk a lot about the third range boundary when we get to trend follow. So that's why we start with it. And just like we said earlier, it's not going to be the easiest trade for you, because technically it's easy. And when you'll get to progress through the strategy, you'll say, all right, back in the days, I mean, learning this fucking third range boundary, it was easy compared to what we're going to have to learn when we talk about reverses or divergences. But this is the technical difficulty of the trade. What makes it difficult is all the surroundings, all the psychology that will alter the real-time application of those markets. Fear of uncertainty and impatience biases, we'll talk about them later, okay? But you need to understand this is a progression. Really, really important for you to understand that. Now I'm going to teach you the pattern, okay? It's a simple pattern, okay? But what you need to understand is that most of the time, the first reaction of people getting to learn this pattern is, man, that's a fucking counter trend trade. What the hell is he doing? The guy is always against the trend. Okay, so let me just settle down for a second in here. Trading against the trend, of course, it's counter trend. Trading against a neutralized trend is called range trading, not counter-trendy trade, okay? That doesn't mean you're trading on the opposite direction of the previous trend, that you're still trading in the trend, okay? When the trend is in pause mode, you can do whatever the fuck you want. It's just dealing with neutrality. So it is not a counter-trendy trade. It's just a low-risk trade in a range. But first of all, we need to make sure that this is a range. So this is all about this pattern. How do we make sure that the range is the most probable structure and that the trend will not keep on going? Because we actually never know. Trends sometimes can get very excessive, and when they're supposed to stop, they're actually just going to not stop and accelerate. So this is not a safe trade, because trend can still reactivate out of nothing, external factors, whatever. So this is why this third range boundary can feel like they're very risky at the first sight. They actually are, but there are also trades in which we're not going to expose much capital. There are very limited risk-reward ratios in there, so this is not a pattern to make money, but this is a pattern to make a significant and to gather a significant amount of information. Very valuable information that we're going to use into much more rewarding context, okay? So understand this, not counter trend. What we take advantage of is a trend maturity that will very likely create an intermediate temporary standing still type of market, a range. Okay, we're going to wait, which means the probability for the trend to keep on going is going to be fairly limited. That's what we're going to be taking advantage of. But we're certainly not going to take a reverse trade. These are freakingly expensive experienced trading contexts, and these are the latest ones I'll be teaching you, how to trade against the trend. But this is definitely harder stuff out there. Anyway, what you need to understand on top of this, and we already introduced that, what I care about is not necessarily a price reaction. What I care about is you being able to highlight this low risk point into an hesitation structure. How the market will react out there is actually what we matter the most out of this pattern. Information is the most important stuff to get out of third range boundary, but we'll actually profit from this later on in your progression. So don't focus on making gains out of these things, but just learning how to master it to make gains later. Okay? And of course, we won't be trading every third range boundary. Like I said, what matters is the reaction. Sometimes there will be just no reaction. So this is where risk limitation actually jumps in. Sometimes we'll get in, sometimes we'll just see the speculative area and just do nothing out of it because it's going to be too risky or whatever. So anyway, even if we don't trade, we're going to need to leave a track. So the third range boundary, more than anything else, is going to give us horizontal level. Okay? Oh, damn it. I don't know how to draw supports and resistances. It feels too complex, too subjective. Wow, I just taught you one way of doing it. And the third range boundary is going to give you very strong horizontal level. But we'll get to the shit later on. Okay? That's really for more advanced stuff. We'll talk about it later on in the progression. What's actually essential out there, and that's a very, very common mistake from those who are learning this pattern, it must be preceded by a motherfucking trend. If you're trading this into a bigger time frame range, means you're in trouble. You don't trade ranges inside ranges. A range all by itself is complicated enough to navigate, and like we said, we're just going to try taking advantage of a single low risk point into this range. So don't try to make it even more complicated with ranges inside ranges, inside ranges, inside ranges, okay? If there is a bigger time frame range, deal with this one instead of looking for a third range boundary in your local time frame. Absolutely necessary that you get to understand that, okay? I suggest we move on to another chart. Okay, so this is going to be this one, the one we talked about. There's actually two patterns I'm going to be teaching you today. They have the same structure, they have the same philosophy, they just have different ways of being put into motion. So don't get me wrong, it's not totally different things, it's actually the same thing, just slightly different in terms of risk management. And we'll also have different risk management structures to follow on these structures later on, as we'll talk about in the next video, which is going to be about risk managing those structures, whether or not we trade them, how aggressively, okay, those things are going to be different for those two structures. Okay, so we call them neutral range for this one, and we call them trending range for this one. It's simple because neutral range basically has all of the neutral structures. Either they're going to be called totally flat structure, when you're going to basically really oscillate into a rectangle, okay, or triangle structures, all of those absolutely neutral structures, and on opposites to what I call the trending range, okay. Of course, the terminology, if you want to name them differently, no problem, it's just the way I call them. So the trending range simply means that we're definitely not bearish trending. We're still in a range, but it looks like trending, and it's generally oscillated because these things are generally lower time frame trends, okay? You see the trend channel in here, it's generally looking like a trend on the trend channel. Same thing in here as well. So you see two impulsive waves in here. For those who are Elliott wave familiar with, this is basically the replicate of the ABC Elliott wave structures, but we're gonna get to make this one a lot more precise and logical and less subjective than Elliott wave has ever done, okay? So we're gonna go way further than that in terms of risk limitation. But this is basically all about it. Neutral ranges, which means the widest possibilities of range structures, definitely where all of the Elliott wave traders are wasting so much energy trying to figure out if this is wave A, B, C of a W, X, Y, and whatever the fuck that is, consolidation. And the classical best way to navigate ranges, which is the trending range, which is the easiest, safest, and healthiest way to consolidate a structure. So even if it looks like a trending bearish range, it actually signs a very much healthy major trend. Remember that we always trade these things coming from major trends. Okay, so when you trade a bearish trending range, means you have proceeded by a bullish range, by a bullish trend prior to this. Okay, and the bearish trending range maturing is going to be a very healthy sign of continuation for an ongoing trend. Okay, we'll talk about that later on. Once again, I'm just spitting out that thing that we'll use later on, okay? So how do we orientate between one or another of these solutions, okay? It's going to depend on why and how we reverse on those areas, okay? Remember that the third range boundary, I didn't call this one randomly, comes out of a first, a second range boundary retracement. We basically, first range boundary is the reverse or final excess, but you're definitely not going to trade that shit. It's just very expensive, very experienced stuff. The second range boundary is also a very tricky trade to figure out, but you're not going to real-time trade. It's actually not a complicated trade, but it's very hard to catch in real time. So what you're going to see when you have a look at this third range boundary is you're basically going to put yourself into a motive, okay? A pattern in which you're going to detect those third range boundary in real-time markets. What do you do? First thing first, make sure you got a fucking trend, okay? If there's no trend, if you're dealing into a bigger time frame range, don't even look at a possible third range boundary. First thing first, getting to that trend. When you see the trend, you don't look at trading kind of trend. This is very experienced stuff. Don't try to fight the trend. Wait for the trend to neutralize. How do we actually put that in motion? Just put a fucking alert on the opposite context. If you do use trend channels, wait for the prices to seriously break off the trend channel, not just one candle away, just breaking and sustaining prices away from the trend channel. At that point, you put your pitchfork and you put an alert on the pitchfork retracement, and you'll see if there is the necessary conditions for you to trade into this area, the one we're going to talk about in the next video. Okay, but that's how it goes. So of course, in here, the replicates I can give you, you have to translate them with your trend channels, but basically the difference is how much do we break, okay? If there is a break and we reverse the context, but if we stop closer to something that generally is 23 or 38% Fibonacci retracement, and you still see a shitload of trending signals in here, late stage trending, but still trending, that means the market doesn't know where to go, okay? And where these things happen generally means the market will pretty much hesitate a lot. They are probably going to keep on trending, but we don't know for sure, and we haven't retraced that much. There are very limited numbers of retracements, which can cause some trend following signals to trigger, but actually the trend isn't probably going but normally the trend already matured, which means the probability to keep on going is very low, but still could exist. And in that perspective, those who were trading the bearish trend will ask for fairly good prices to get out. Remember what we said, we're going to buy their profit taking. We're going to pull them off the market. They're going to risk manage. They traded the trend. They risked manage it, probably using derivative contracts. They've looked at the reaction, and depending on the reaction, they'll say, all right, it's pretty mitigated. Anytime we get into bullish demand area, the bulls are pushing really the bears are pushing really hard. They rapidly reverse prices out of Fibonacci retracement. Okay, the bears are still in place. So as a bear, I'm going to ask for a fairly nice price to reverse. Okay, so this is where I'm going to trigger my profit taking. I'm going to ask for better prices than the average, though the demand area. Okay, so pitchfork, you're going to trade below the pitchfork area I gave you. Okay, what we're going to add on top of this is the fact that when you see this pattern, you need to reverse the context. That's absolutely necessary. So remember what we said, look for a trend. Put an alert on the opposite context. Don't try to look for this trade. You don't give a shit. When this alert's triggered, you put another alert onto the opposite context. What you look for is this pattern, trend, pull back to the context, and then going back to this one. When this alert's triggered, you're just going to verify one thing. Did we reverse the context? If the answer is a yes, you know a third range boundary is down the corner. You're not necessarily going to trade it. Remember what we said. Highlighting doesn't mean trading, but highlighting is key. So you know a third range boundary is down the corner. You just need to highlight it, and trading it or not is going to come later on. So what you do out there is, though, first of all, you assess if you reverse the context. If so, yes, then the second question you might ask yourself is, am I going to go for this option or this option? How do? You study the first and second range boundary movement. If it stopped at a very low level of retracement, and if it rapidly reversed after reversing the context, if it rapidly gone bearish again, that means that, yeah, the bears are really demanding on prices, and they're probably going to ask for better prices than the average. And in that perspective, we're going to use deeper Fibonacci retracement, because that's the thing about this pattern. We just don't care about reversing the context. What we care about is Range is uncertainty. And uncertainty actually isn't the only factor. In a range, the market is just uncertain about what comes out, so it's going to wait for external information. And that also means this can take a shit ton of time, and impatience can come at play, but we don't have to follow it. So the reason why we're not just using time-based analysis, because remember, the context will evolve with time, and as time passes, they will ask for better and better prices. But the problem is sometimes some ranges will need more time than what you think. And in that perspective, the context might be met way earlier than they should. And in that perspective, this is why we use a time-based analysis with the context and something that isn't time-related, which is Fibonacci's. Basically, you're going to put your Fibonacci's out of the first and second range boundary. At that point, fairly easy to understand. Okay, but what you need to figure out is that as long as prices are in between those boundaries, your Fibonacci's are going to just stand still. They are not evolving in time, okay? Your context will rise, but not the Fibs. So the Fibonacci's are there to compensate the fact that sometime impatience over the investors might be causing some more aggressive entries, but you shouldn't get down this road. You don't want to be aggressive in a range. You want to be safe, and that's the reason why we ask for at least a 76% Fibonacci retracement on these neutral ranging context. Because the stop loss will be very cheap, and if you decide to get in, and if you ever end up being proven wrong, you're just going to lose a very tiny fraction of capital, okay? Because like we said, we don't care about those patterns to make significant amount of money. And actually, to be fairly honest, we use those third range boundary gain to buy the trend or sell it, depending on the bearish trend. So the third range boundary is just a tiny little trade, useful to be safer entering the trend later on. But no more than that, it's not a rewarding trade. It's more of an information gathering trade, okay? So in a second perspective, as you can see in here, we do have something different. The second range boundary reacted totally differently. Instead of reversing immediately and rejecting as they reverse the context is reversed and price keep falling into the negative context. Okay, multiple closes below the context are generally the case out there. And instead of reversing out of a very precise Fibonacci level retracement, we generally retrace in the middle of nowhere. Like this wave feels like, what the fuck is going on? We don't know, but we stopped it in the middle of nowhere. And generally, like we said, this trend channel will definitely have a trend feeling. Okay, it looks like something has looked trendy into the opposite time frame, which means sometimes we generally even break an intermediate support. We don't last very long out there, but we generally just break a tiny little level from the preceding upside trend. And in that perspective, you have fairly high reasonable chance to say, okay, what do the bullish investors think at that point? They have probably hedged the portfolio out there. They've seen the response. They say, oh man, the response is pretty solid. There are definitely a lot of people risk managing their bullish entries. So I'm going to be less demanding on terms of profit taking. This is where I cover up the portfolio. This is where I actively reduce my exposition. The third range boundary is definitely a taking profit of the trend followers. Okay. So in there, we're going to say those who have been trend following are going to profit take, and as they've seen quite a solid reaction, they're going to trade any available price that matters. So they're going to trade inside the context. They're not going to ask for much better prices. They're going to be convenient with these, and they're generally going to ask for less retracement. And in that perspective, instead of a 76, we take for a 61%. So that isn't that complicated. This is actually all about it. The simple difference between the patterns is how we reacted to the first to second range boundary. The psychology is just people don't know shit. They're just going to gather information to figure out if they're going to be demanding prices or less demanding, and they really want good prices to get out. Okay, so this is really all about it, and either one of those choices will be, I feel like people will get out early, so I need to do the same thing, so people will start profit taking at 61% retracement and ask for prices at least in the context. And if they say, all right, the thing is pretty neutral, the bears are still there, the bulls are not really, I see a very few risk managing in here by the fact that low level of retracement, Fibonacci, very clear and neat risk management, they'll say, okay, all right, no matter, I'm going to ask for good prices and I'm going to profit take, of course, partial profit take, but yeah, I'm going to wait for good prices to do such a thing, okay? That's how it goes. So you need to understand. no trend to proceed, just get the fuck out. What we take care of is the profit taking of those who were trending. So if you're in a bigger time frame fucking range, means no trend, means you're totally destroying the risk management of this pattern. It only exists because what we're trading in there is not randomness of a range, trading profit taking of those who previously were trending and might be just like you do, figuring out that the trend is on a pause state. So this is not a counter trendy trade. This is a hesitation, a risk limitation trade for those who are trend following. And that doesn't mean we're not going to re-follow the trend later on. Most of the time that depends on how the third range boundary behaves to figure out if whether or not we're going to trend follow again. Okay, but we're going to figure out this stuff later on. Finally, I think, yeah, we need to have a look at this. We're going to take a few examples out there trying to figure out what does this thing look like into real-time market behavior and what are the general common mistakes that most trader does into this context. Okay, so these are the 4 mistakes. I'll show you them one by one. 4 ground typical mistakes that every beginner learning the third range boundary will do. So let's talk about the first one. So I've been putting big boxes and tinier boxes because remember the strategy uses 2 time frame, and therefore I want you guys to be able to figure out the third range boundary out of 2 time frames on the same charts. Okay, and most importantly, to avoid the first error, trading inside a bigger time frame range, which means when you see a third range boundary opportunity, just zoom the fuck out to the higher time frame, making sure that you're not already into a bigger time frame range. That's absolutely necessary because otherwise you're breaking the major rule. You're in a range and you're trying to figure out a smaller range in a range. I mean, just making it more complicated. It's not going to make it easy. Okay, so third range boundary exists on the context when you see the pattern of a trend, reverse, and pull back to the context with a minimum 61% at least, or even 76 when hesitation seems to be fairly at play. So in here, that's exactly what we're talking about. The market has retraced 61%, the context is negative. We'll say, okay, there is a speculative third range boundary. Does that mean we're going to trade it? No fucking way. Second mistake, you need to understand that this is not about just trading these things, but highlighting where they are, because we're going to gather a shit ton of information, even if there is no reaction. Actually, breaking through a third range boundary is going to be a freaking pattern I'm going to teach you later on as you get experienced, okay? So a broken third range boundary will give you an horizontal level that we care about, okay? And as you can see, historically speaking, if you've highlighted this level, that would have helped you into multiple trades, specifically this one later on, but that's a topic for another day. Much more complicated pattern. Okay, but until then, if you didn't highlight that, there are several later on opportunities that you'll have missed. Okay, but anyway, the market broke to new high. Therefore, in that perspective, the wave count starts all over again. You had a first range boundary, second, and the market just didn't react to the third one and made new highs. So you're still in your trend. Okay, you've restarted the wave count. First range boundary, which means second starts building in here, keeps pushing in there, and third range boundary starts there. But fails and terminates its way in here. We'll explain how it goes, okay? And later on, everything after this is a fourth range boundary, which means mature range. So anything after this is okay. There's not going to be any lower time frames for the range boundary. So this one, okay, you could say we have a trending behavior. It looks like the trend channel is trending. We'll reverse and we pull back to the context. So this is a third range boundary. Fuck no. If you just zoom out, you'll see that on the bigger time frame, you just made a third range boundary. So this is a mature range context in here. We're probably going to buy out there, but definitely not with the same set of rules. This is an absolutely different type of pattern trading. In here, we're trading fourth range boundary, which is a trend following opportunity, which is a totally different stuff we're going to learn later on. Okay? So don't invent trade, don't bend the rules, don't try to mix things up. Everything has to be right into its precise spot. Third range boundaries come from a range. They don't come from a mature range, and then certainly don't exist into bigger time frame ranges, okay? So this one is a bullshit trade because you actually failed with the first rule. This one, why do you think this one is a wrong third range boundary placement? There's the pattern, making new highs, first, second, retracing to the context, but I mean, not enough Fibonacci retracement. We're barely retracing 50% in here, so it's not enough for investors to speculate in the range. They're going to ask for better prices. In both case scenario, even if that things could look like a bearish range because we actually broke the context, hold it closes below them, that could be a bearish trending range, but at least 61%. So if we have been slightly higher in there, we could have triggered a third range boundary speculative area. But in here, we just failed. We gone flat, waiting for something, though in here, the only thing that's at play is your impatience biases and fear of uncertainty. So if you do trade in this area, the only thing that actually triggered the trade is not the third range boundary rules. It's just you being impatient. And you're going to say, all right, we've got 50% retracement. That's more than enough. I'm jumping in. What the fuck? Why are you doing this? You know the rules. You're just getting impatient out there. Okay, so in here, that's the typical impatience biases at play. Okay, don't invent areas if you don't met the rules. The rules are fairly simple, actually. You just need to embrace them and put them into motion. Okay, absolutely necessary. And finally, like I said, you need to figure out what happens into multi-time frames. So always verify the higher time frame. One way of doing this is to highlight the third range boundary when you look at the higher time frame. That's the best way to avoid trading into a bigger range. So you know that the trend channels are the contexts of the lower time frame. So when you figure out the third range boundary, it's always easier, at least for me, that's the way I do things. I generally highlight the third range boundary into the trend channel. That's the same pattern, all right? You need to see a trend, you need to reverse the context and pull back to the resistant context. So there could be an approximate area for a speculative third range boundary, retracing 61%. Okay, we're in the context, everything's fine. So why isn't there a speculative area out there? You would say, Jesus, there is. The pattern is there. I see it. What the fuck is going wrong, Phil? Why do you delete this one? Well, simple rule. You're inside a bigger time frame range. Just this one isn't mature yet. But you're still dealing with the first and second range boundary of a bigger time frame range. Oh, why is that? Well, man, you actually reversed the context in here. So when you reverse the context, even if you've reversed your trend channel, you always deal with the bigger time frame. So in here, the third range boundary is existing out there, but definitely not existing in a shorter time frame. Okay? So that's one thing. You need to understand that. When there is two time frames reversing at the same time, you're always going to take the bigger one. Always take the biggest option, the bigger time frame option. Okay? But this one, why is it existing? Well, if you don't highlight this one, you're going to have troubles with the strategy, because in here is actually where you would have figured out the trend was over. So if you don't figure out this third range boundary, you're going to miss a seriously important information, okay? So the market makes new high. So it's a new wave count. This is a first range boundary. You still have made any second at some point. The context is still bullish out there. So yeah, there is definitely the pattern. Bullish trend, reversing the context, and pullbacking out there. That's definitely what this is all about. Okay? And finally, last but not least, it is a very important one. There is sometimes an indicator lag. Okay? And that's exactly the case in here, because you're going to get your detection probably out there, which means when you set your alert into the resistant context out there, this is where you're going to be triggered. At some point, you'll see the market has already made two sets of wave. It has already ranged into the lower time frame. So in that perspective, even if you get your alert triggered out there, the real third range boundary was already done in here. Okay? So sometimes your lag in the indicator will cause you not to be able to trade the third range boundary, but you still need to place it well. We'll do a specific prospective and podcast about it, and we'll talk about it in the next into the next risk management stuff in here as well. Okay, so I saved that for later in order not to be too long out there. Anyway, we do have more than enough to get into conclusion out there and summarize all of the information we spread it out there. So yeah, let's switch to conclusion. All right, so third range boundary as a core information. If you think this is just a simple pattern, yes, that is. Applying it into real-time market will create a lot of problems for you, because this is the heaviest amount of risk and putting at risk for your impatience biases, okay, and fear of uncertainty, because you're going to be dealing with range, though you're going to be dealing with a lot of uncertainty and a lot of patience required, as you won't be able to master how timings play out. Informations will come as they decided to. So you will have absolutely no control. Time will be totally an elastic thing out there. So what's actually going to be difficult for your progression into third range boundary is to progress with your bias, uncertainty biases and impatience biases. That's what really is going to be all about. So we're going to make specific podcast about them. The technical structure all by itself, real simple. Really open your ears a lot in here. The pattern is simple. You need to have a trend. Real trend. You need to neutralize the trend. How do you neutralize it? Either you break the trend channel if you're not using the tools, or you reverse the context, okay? When you reverse the context, you're going to need to pull back into the opposite context. Or if you're not using the tool, getting into the pitchfork, which is going to be opposite to the trend. So use either the inside pitchfork or the original one, but you need to have something that is going on the opposite way of the trend. What you're going to be doing is looking at how price react into this very specific area. Ask for at least 61% retracement, even for the less demanding option, okay? So it's really a bare minimum 61, sometimes up to 76. What you care about is how price reacted out there. If you're not really familiar with the bearish trending range or trending range and neutral range opportunity, ask for more experienced people. They will definitely help you out this way. But I told you the essential out there. It comes from the study of first to second range boundary, and it's not that complicated. You'll get used to it throughout the 6 months to a year progression into this thing, okay? And you'll get to progress with this as you also progress with your psychological management, okay? Learning the patterns, try not to make mistakes. Remember that what comes out there is that it's simple, but if you make mistakes, you're destroying all the risk management. You're going to make those mistakes, but make sure you highlight them and that you force your brain to detect those possible mistakes so you don't make them later on, okay? The most classical one is the one of not looking at the higher time frame and therefore putting some third range boundary that absolutely doesn't exist. Okay, trading them is a totally different manner. We're going to be talking about this into the next podcast. Some of the areas will be highlighted and will not have sufficient risk limitation to trade them. So we're going to still take the information, but not taking the trade. On the opposite direction, sometimes the area is just totally fucked up. The price doesn't even react. And at some point, we still need to highlight the area because we're going to figure out some very demanding, some very important information out of prices not dealing with the speculative area. But yeah, if you miss this thing, and some people do because they just have a look at prices and say, okay, price didn't react in here, so you don't even look at this area. What you need to look at is how context behave, not just prices. Okay, sometimes price will just fuck up this pattern, and if you are not experienced enough to look at how context reacted in those areas, you're going to miss those third range boundary opportunities that got fucked up, and there are a shitload of information for trend following. So you need to find these ones, okay? And be aware that finding one doesn't mean the trend is over. There can be some intermediate consolidation in a bigger time frame range or in a bigger time frame trend. So third range boundary, when too much risk, we don't trade them, but we need to highlight them. They're going to give us horizontal level, and they're going to give us a plenty shit ton of information for trend following opportunities, trend healthiness associations and stuff like that. It's really a keystone and a corner for your progression. If you don't master this thing, then we're going to have a lot of problems. So what I care about you is not necessarily being a multimillionaire trader with this pattern. It's not going to happen. This pattern is definitely not meant to bring money. It's just meant to help you understanding how things works, preparing you solidly for trend following later on, because we're definitely going to need that. And more importantly, working slowly but patiently on your impatience biases and fear of uncertainty by putting you into the most difficult context in which, of course, they're going to be put at risk. You're going to make a shit ton of mistakes. They're probably going to be psychological management mistake. But if you understood the process, this pattern doesn't bring a lot of money. So you're not going to invest a lot of money in there. So when you're going to make mistakes, those mistakes won't be costing you too much. But what they're going to bring to you is eventually tiny little losses. They're part of the job. Everyone loses money in the beginning. So invest on your progression at some point and don't take that as hard losses, just way of getting better. And even if you lose a little bit of money on these trades at the beginning, what you get is you getting better at managing your fear of uncertainty biases and impatience biases. So your actual goal into progression over the third range boundary is to get better at psychological management, while still figuring out how to frame your decision-making process into a set of rules and getting used to strategically trading instead of random gut whatever the fuck you were doing before that. So you're getting yourself into learning a set of rules. That's just going to be the basis foundation for something more complex stuff that will be rewarding later on. Until then, work your psychology. So if you got me right in here, you're not willing to make money out of third range boundary. You're just willing to learn the pattern. In order to learn, you're going to need to trade with real money. That's what we said in the previous podcasts. So as you're not going to make money, but you have to trade with real money. Trade with really tiny amounts. The tiniest possible amounts are the best ones in there. Okay, work your psychology. Takes generally 6 months to a year to get mature with these patterns, totally master them, being sufficiently reducing the amplitudes of emotions in the market, slowly getting to expose the capital, and later on we get to the real deal, the trend following stuff and whatever. We'll get to this one later on into this channel, of course. So I think that's enough for today. I wish you guys a pleasant following of next videos, and all right. Be nice with you. It takes a lot of time to process this thing. Don't try to rush things out. 6 months to a year is an average thing out there. So yeah, it might sound like, man, this simple. It's not going to take 6 months. Yeah, it will. So don't make it faster. Faster doesn't make it better.